So we're going to walk through this somewhat thoroughly, or I should say very thoroughly. What we will always analyze here first and foremost is what does the policy look like if I just pay money in and let it sit and grow. This way I have a comparison when I actually look at the premium financing model, I've got a gauge to compare it with. So we mentioned that an insurance carrier and lender for that matter is going to carefully review the guarantees. It's going to happen, has to. Everybody wants to make sure they're protected. So we'll always look at the guarantees. This was a case we looked at with an individual paying in $260,000 per year for 10 years, or I should say, this was the annual amount financed, so a total of $2.6 million. It was actually on a couple, so multiply this by 2. We looked at the same scenario for each. But this is all the same product here. What it looks like based off the pure guarantees, this company's present dividend rate, and then also they have an indexed assumption. Now what I'll add here is I would not in any circumstances assume that the best looking scenario is going to come true. And going back to the topic of leverage, where we'll often hear you can leverage money at 3% to feed a policy that may produce between 5%, it's typically the best case scenarios modeled with a life insurance policy stating, yeah, this should definitely happen, no problem. But then if it doesn't happen, that interest is going to continue to occur from the lender no matter what. Important to be aware of this stuff. I would always go conservative here, typically somewhere between the guaranteed rate and present dividend rate. But right here, this just displays pure growth. Okay, sounds good. Let's take a look here. Let's look at the most aggressive to start. Look at this chart. A lot of stuff going on. Let's walk through it. So, what we've got, the financed premium. So $260,000 per year for 10 years on a 50-year-old individual. This money coming from the lender to the insurance company to fund the policy premium. Now the policy was designed very, very aggressively, $260 going in, $225 in cash value right off the bat, heavy blend, minimum premium, maximizing the PUA and cash value like we do for anyone, regardless if we're looking at financing or not. There's the annual finance. Here's the total loan balance, $260 per year. By the time I hit year 10, $2.6 million. The loan interest rate can definitely get lower than this, or I should say most likely get lower than this, but we do like to run these models more aggressive. When I say aggressive, going towards more of a worst case scenario. If it works, or I should say if I'm comfortable with the strategy based off the worst case scenario, then if it does better than the worst case scenario, I'm happy. If I'm uncomfortable with it and I'm banking on hypotheticals to occur to increase my comfort level, that's where I want to look at it and say, okay, let me reassess this to see if it's actually a fit for me or if I should look at a different approach. Maybe it's not premium financing. I'll mention that the reason why premium financing, which ties right into the whole topic of leverage, why it is so strict, why companies look at it so closely and the underwriting and case review is so thorough, is back in the day, a contact of mine would call it the Wild West days, where people would really offer it or sell it as a means to get free life insurance because the policy performance should outweigh the loan interest that I'm using to finance the policy. And what ended up happening is the lawsuits were just more than you can count. And there's still a ton of them today for cases that did not work out, meaning a client thought they were going to have $1 million, they thought the policy could cover the loan interest, and it ended up not happening. They had to come up with additional out-of-pocket, additional collateral, was not pleasant, so they filed a lawsuit stating, I didn't think this was going to happen. Whether they did or not, it was a big mess. So that's why things are so restrictive here today, and why when the topic of leverage comes up, my comfort level is not there. So we've got the loan interest at 4%, loan interest payment, total out of pocket, we added this column. So I want to know I can just pay $260,000 per year. That's $2.6 million over 10 years. Or I can cover the loan interest out of pocket. And if I do that every single year, by the time I hit year 10, I'm paying $104,000 per year. By year 15, because I'm still paying the interest expense, I've laid out $1.1 million approximately out of pocket. At that point in time, the next year, we take a policy withdrawal, not a loan, a flat withdrawal from the cash value, that's where you see the drop here, and pay off the loan. We can withdraw up to our cost basis. The cost basis on this example was 2.6. I still have 1.4 in cash value. Death benefit's about 3 million. The gross death benefit assumed what the policy death benefit was if I never touched it. So if I just funded a policy with $260,000 per year, that would be my death benefit. Now, death benefit net of loan assumes as the years pass, if I kick the bucket prematurely, let's say I die year 10, gross death benefit, 7.75, net death benefit, 5.15, meaning the lender needs to recover their $2.6 million. Last column I want to touch on here that is important to touch on is the additional collateral needed. So year one, $260,000 is financed. Net cash value is $225,000. If life happens and they call the loan for whatever reason, the cash value in my policy can be used as collateral to increase that lender's comfort level. With that said, if they lend me $260,000 and I have $225,000 in cash value, that's not enough to cover that loan balance. Additional collateral is needed in any situation. By the time I hit year 4 in this example, the cash value exceeds the loan balance. So in this scenario, it works. My out-of-pocket was 1.1, where 2.6 million got into the policy, but really I look at it in this manner. I paid in 1.1, and I've got 1.4. Positive cash value. As time passes, cash value continues to grow. Right, 30 years down the road, I've got 2.7. Looks great. The thing is, that's based off of the indexed value assumptions, the best looking scenario I can obtain from a policy performance standpoint. So we're borrowing at 4% and the policy topped out at a 5% earning rate. If I look at the dividend example, which will not look as attractive, let's take a look here. Let's look at year 16. Start to get more conservative here. 2.6 taken out via policy withdrawal. My actual out-of-pocket to cover the loan interest is 1.1. If I did not cover any loan interest, if a lender is allowing that, that loan balance would be much higher, which is going to extend the period of time from when I can actually pull money from the policy to clear that loan. 1.1 cash value, when I take the policy withdrawal out, is just over 1.1. So what I'm saying here is our actual out-of-pocket, $1.1 million, and I've got just over $1.1 million in year 16. Okay. Now granted, I had a death benefit all the way through if anything happened to me, and I had a very, very low out-of-pocket in the initial years. There are times when this makes sense. Now, if I have any intention to use my cash value in the early years, well, here's my gross cash value, there's my net surrender value minus the loan balance. Very difficult to do. There is a collateral assignment on these products, or I should say with these strategies, where if I want to access my cash value freely, I won't be able to. The lender needs to sign off stating, hey, you can take this money out because there's still sufficient cash value in this product to cover our loan in the event you defaulted. So for example, year 7, I've got almost $2 million in cash value, but I've got a loan of $1.8 million. So my net surrender value is $145,000. If I wanted to pull any amount of money and the lender approved it, that would likely be the max. Let's look at one more scenario here. Interesting stuff, right? I know this is a bit complex at times. Guaranteed values. Same thing from the lender. $260 for 10 years, 4% cost to borrow, total out of pocket, $1.1 million. I take that policy withdrawal of 2.6 to satisfy the lender. I no longer have a loan. I funded the life insurance policy, or I should say the lender funded the life insurance policy. I made the loan interest payments. What do I have in cash value? $740,000. And again, we put this column here for a reason. I dished out about $1.1 million. And again, granted, I had life insurance all the way through. So there are times this does make sense. But there's a lot of times it does not. I remember talking to my father years ago when he considered this. My father's never been in the life insurance industry. He's been in construction and real estate, but he was considering this, or we looked at it at one point in time. And really, what I was trying to do was every way possible to see, hey, how can we make this work where we can reduce his out-of-pocket and leverage the life insurance policy really to just clear that loan at the end of the day. Minimum out-of-pocket for him where he can get the best of all worlds. And the thing was, no matter how I sliced it, looking at it in a conservative respect, not based off of the present dividend rate and things going oh so well, but in a conservative respect, it just didn't work. The comfort level was not there for me. If I was him, there's no possible way I would do that. And that's the kind of stuff we've got to look at and consider for other individuals. The issue with any type of leverage situation, in my opinion, is we see more often than not individuals stating, hey, a whole life insurance policy should produce these fantastic returns, or an IUL, it's even better, and you can borrow no problem because the interest earned on a policy will exceed the interest due on that loan. And in reality, we have not seen that to be the case. Well, let me rephrase. In reality, we have seen whole life policies produce between 4 to 6% as far as a net IRR. Those were policies that lived through the 80s, 90s, and early 2000s. More recent, I'm expecting it to fall between 3.5% and 5.5% as far as a net internal rate of return. So I've got to be aware of that before I look to leverage money. And if I want to use my cash value that I pay into a policy, typically a leverage scenario where I borrow from an institution to fund a policy, I wouldn't do it because I restrict my access to cash value. Know that this is a ton of information. If you have any questions or would like to see additional videos or talk through it, reach out anytime. Hope this helps, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.